Okay, we're going to look at the S&P 500 is the 500 biggest companies on the market in the United States. So if you don't know anything about stocks and you just want to go in and say put in weekly or monthly contribution and you don't really know anything about the stocks, you could use the ETFs they have. This one here is Vanguard S&P 500 ETF. And that actually gives you dividends too. I didn't even know you could have dividends. That's kind of neat. That offsets some of the charges that fund takes. So well-known index, the S&P 500, large caps. It's mostly large caps. It's this one here, iShare Core S&P 500 ETF. They got low cost too, because mutual funds have much greater cost of buying them. These ones have like a little tiny percentage. Again, this one has I didn't even realize 1.15%. So it actually won't cost you anything, I don't think, because if that is true, dividends indicated, so they charge you like 0.05% or something. So if you take it long term, mutual fund will eat a lot of your growth. So ETFs are much better. So let's see here. This is daily. Let's go weekly just to see how this whole market goes. So basically from when the bubble burst from 2000 to about 2007, it didn't do anything really. If you put it here, unless you put money here, monthly, you'd be way ahead. So it's better to put it every month, money into it. And then 2008 hit, or 9, and it's 154 to 69. That's a big hit. So from this here, about here, that's about 13 years with zero growth. But if you invested here, your growth would be actually pretty big. So a lot of times it's not really good to invest at one time because you don't know where the market is going to go. But here, if you did have cash laying around, that was beautiful point to enter. And what I noticed is the presidents of the United States, they give you little clues, but you don't even know. I think Obama did that. Donald Trump did that a couple of times. They go up, it's a good time to invest, and when they say that, they know. Somehow they know. So from there on, it kind of went up. Oh, this one's very interesting. Very, very interesting. I was looking at the triple one morning. I woke up and I go, what's going on? The triple 3 times bull went down 60% in the morning, and then by the time noon rolled around, it was up again. So if you look at 200 here and 150, that's like 20% drop. So that's where the triple ones were, and something happened. So if you let's say if you got it set that they'll sell when it goes down 20%, you lost a lot of money. So in this case, if you didn't set that, if it goes below 20%, you sell. Or if you got the triple or even any stocks on that day in the morning, you'd be 20% up. And that was, not sure when it was, but that was in August, sometimes in August. Yeah, it went crazy, the market. I remember that. And if you went to work and came back, it's like nothing happened because it went down in the morning, went up. And then we hit 2000 COVID. Again, it's beautiful. If you got money laying around, it's beautiful to invest. It was 345, went down to 28, went up again. And then right here, I think this tariffs was introduced, went down, and it went up again. This is SPY. People have this one, a lot of them, but as you can see, they all they follow the same. So these are United States fund, VOO, IVV, SPY, and these ones are Canadian. They also follow the, this one was 13, 22. Oh, the S&P 500 index. I gotta check that one out. Why is it 26? And then, what does it do? Large cap 500 index. That's an interesting one because it went quite a bit from 25. So that's, wait, okay, that's January 13. Let's see here. 213, 213 is here. So that's 115. So that's about 5 times. Is this 5 times? 25, so it should be a little bit more. So yeah, it's just a different starting date. That one's 213, but yeah, if you invest in here, $25. Now it's about 600% in the last 20 or 13 years. That's another one here, as you can see. That one started in 2013 too, and that would be in Canadian dollars. And that one, S&P Corp. So they all follow the same thing. So if you don't know what you're doing, just put monthly into that one. The only thing recently is you can even see it here. 10 largest companies, and 8 out of 10 are tech stocks, and they kind of follow each other. So it's a little bit like Nortel a long time ago, where TSE 300, the 300 biggest companies in Canada, 36% of that whole index was Nortel, and when it went under, people lost billions of dollars everywhere, their RSPs everywhere. So this one you gotta be careful, because now it kind of acts almost like an individual stock. You can see that dip right there too. Yeah, a lot of money was made here. For some, not all. But yeah, it will. I think from now on it's going to act a lot like a single stock, because top 10 companies, at least 8 of them, is tech companies, and they kind of follow each other. So even though there's 500 companies, those top 10, especially when they're in the same industry, they could sway the market up and down like crazy. Here looks like very steady, but I believe going forward, it will be more like this, up and down, just because they're too heavy. Those 8 companies, tech companies. I think that's it for now.